Welcome to Marty's Money, where we break down financial concepts in simple, relatable terms to help you make smarter decisions about your investments. Today, we're going to dive deep into the basics of accounting that you need to know in order to evaluate the earnings and performance of stock companies. Whether you're a new investor or someone looking to sharpen your skills, understanding accounting is essential for making better decisions about where to put your hard-earned money. Why is this important? Well, by understanding accounting, you'll be able to read financial reports like a pro, assess how well a company is really doing, and avoid bad investments. So let's get started on your journey to financial success. So why should we care about accounting? At its core, accounting is the language of business. Just like learning any language, understanding accounting gives you the tools to decode what's really happening inside a company. For an investor, this is crucial because companies use accounting to create their financial statements, the balance sheet, income statement, and cash flow statement, documents that tell us how well the company is performing. When you know how to read these statements, you can better evaluate the health and growth prospects of any company you're considering for your investment portfolio. Let's break it down and start with the three most important financial statements: the balance sheet, the income statement, and the cash flow statement. Each one gives us a different perspective on the company's financial health, and together they provide a comprehensive picture of how the business is doing. The balance sheet is a snapshot of the company's financial position at a specific point in time. It tells you what the company owns, its assets, and what it owes, its liabilities. The difference between these two is known as equity, which represents the value left for the shareholders. Here's the basic equation that every balance sheet follows. Assets equals liabilities plus equity. Key parts of the balance sheet: assets. These include cash, inventory, property, equipment, and accounts receivable, money the company is owed by its customers. Liabilities. These include debts like loans and bonds, and accounts payable, money the company owes to suppliers. Equity. This represents the owner's stake in the company after all debts have been paid. It includes common stock and retained earnings, profits that the company reinvests rather than distributing to shareholders. Let's say you're evaluating a retail company. Their balance sheet shows total assets of $500 million, liabilities of $300 million, and equity of $200 million. This tells us the company has more assets than liabilities, always a good sign. But to get a complete picture, we need to look beyond the balance sheet alone. Next up is the income statement, also known as the profit and loss statement. This tells us how much money the company is making or losing over a certain period, typically a quarter or a year. Here's what to focus on: revenue. This is the top line and represents the total sales or income the company generated from its main operations. Expenses. These are the costs of running the business, including things like wages, materials, and marketing. Net income. The bottom line is what's left after subtracting expenses from revenue. This is the company's profit or loss. When reviewing the income statement, pay special attention to gross profit, operating income, and net income. Gross profit is revenue minus the cost of goods sold, or COGS. This tells you how much money is left after paying for the raw materials or products. Operating income gives you a sense of how profitable the company's core business is before considering taxes or interest payments. Net income is the final number. It's what matters to shareholders because it shows the company's actual profitability. The third critical financial statement is the cash flow statement, which tells you how much cash the company is bringing in and spending. Cash is the lifeblood of a business, and even profitable companies can go bankrupt if they run out of cash. The cash flow statement is divided into three sections: operating activities, cash the company generates from its regular business operations; investing activities, cash spent on long-term investments like buying equipment or acquiring another company; financing activities, cash raised from borrowing money or issuing stock, or cash paid out through dividends or repaying debt. Let's break this down with an example. Imagine you're looking at the cash flow statement of a tech startup. The statement shows that the company has a positive cash flow from its operating activities, meaning it's generating cash from its business. However, the investing activities section shows heavy spending on new technology and facilities, which is expected for a growing company. But what's concerning is the financing activities section, where the company is issuing large amounts of debt to cover the costs. This might be a red flag, signaling the company could be overextending itself financially. Now that we've covered the three key financial statements, let's talk about some important metrics investors use to evaluate a company's performance. Here are a few you should know. Earnings per share, or EPS. This tells you how much profit is allocated to each share of stock. It's a key indicator of company profitability. Price to earnings ratio, or PE. This shows how much investors are willing to pay for $1 of the company's earnings. A high PE ratio can indicate investors expect high future growth, while a low PE might suggest the company is undervalued. Return on equity, or ROE. This measures how well the company is using shareholders' equity to generate profit. Another critical metric is free cash flow, which shows how much cash is left after the company pays for its operating expenses and capital expenditures. Free cash flow is important because it can be used to pay dividends, buy back shares, or reinvest in the business. For example, a company with strong earnings but poor cash flow might struggle to sustain growth, while a company with consistent free cash flow could be a safer bet for long-term investors. Chapter 4. Red flags to watch out for. Not all companies are as financially healthy as they appear on paper, so it's important to look out for red flags when analyzing financial statements. Some key things to watch for include declining revenue. If a company's revenue is shrinking over time, it could be a sign of trouble. Rising debt. Companies need to manage debt carefully. If a company is taking on more debt without growing profits, it might be in trouble. Negative cash flow. If a company consistently burns through cash, it might face liquidity problems down the road. Another red flag is inventory buildup. If a company's inventory is increasing faster than sales, it could mean the company is struggling to sell its products. Also, pay attention to one-time expenses or non-recurring items. These are often used to make the company's core profitability look better than it really is. Chapter 5. Making better investment decisions. By understanding the basics of accounting and how to read financial statements, you're better equipped to make informed investment decisions. Instead of relying solely on what analysts or the media say, you'll be able to dive into the numbers yourself and form your own opinion. Let's recap what we've learned. The balance sheet shows what a company owns and owes. The income statement shows how much money a company is making or losing. The cash flow statement shows how much cash the company is generating and spending. Use key metrics like earnings per share, price to earnings ratio, and free cash flow to evaluate performance. Be aware of red flags like declining revenue, rising debt, and negative cash flow. Thanks for tuning in to Marty's Money, where we help you make smarter financial decisions. Remember, understanding the basics of accounting is your key to evaluating company earnings and making better investment choices. Stay sharp, do your research, and you'll be on your way to financial success. If you found this video helpful, be sure to like this video and subscribe to the channel.